Hey everyone, welcome back to the Mark Loeffler Experience. We have a great show for you today. We're talking no money down real estate. We're talking you don't need any of your money out of your own pocket to buy real estate. If you haven't subscribed, go ahead and do so. Click the like button and turn on that notification bell so you get updated every time I release the video. By the way, guys, apparently comments are the new monetary value on YouTube. So I want to hear your comments down below of what you think what these strategies will do, if you've ever used these strategies, if you need any clarification on any of these strategies I'm going to talk about today. Definitely comment down below. I do respond to all comments. Let's get into it. No money down real estate. How does it work? I mean, we've had Jeff Borum on here talking about how he has a line of credit from a bank on his other properties that he then go ahead and buys off that line of credit. Jeff doesn't use any of his own money to go ahead and buy that. So, I mean, at the end of the day, it's OPM. Whether it's a bank's money, it's a private lender's money, it's your rich Uncle Gary's money, or you have a joint venture partner, they're all, and we're going to talk about how all of those fit in and that type of thing. Yet, a lot about buying zero money down real estate is mindset. So I talked to a lot of investors at first, and they're like, well, I'd never pay 8%. I'd never pay 8% for a mortgage. And I look at them and say, okay, well, why not? Well, that's too much. Well, great. Too much for what? We don't know the context. I mean, if I'm paying 8% on a mortgage and I'm getting a 12 capitalization rate, which means I'm making that extra 4%, and they're going to loan me 100% of the money, I think I'm doing okay, right? Like, I'll cash flow on the property, and in time I can work on getting better financing. So a lot of this stuff is how we look at it. I talk to a lot of investors who say they get stuck at 5 properties because the bank won't finance them anymore. They're buying single family duplexes, that type of thing. And there's obviously ways around that, yet one of the ways is to go to a B lender or private lender. If these are good enough deals, then what you're getting charged in interest shouldn't matter. So, I mean, and look, there's ways to skin every cat, and nobody has ever commented on below where that comes from. I still want to know, so let me know where the phrase to skin a cat comes from. Super interested. I mean, yeah, I could Google it myself, but I want you guys to tell me. Make up a story for me at the very least. I used to flip properties. I would have a private lender who would lend me all the money to buy the property. So I'd buy zero money down. So I bought a $300,000 property. They'd lend me $300,000 at an interest rate of 10% for 6 months. I would go ahead and flip that property, and I could make $80,000 to $100,000 after I pay all my interest, after I pay everything. So is 10% expensive? That's what I'm asking you. Is 10% expensive? Would 15% be expensive? 12%? I mean, probably not at the end of the day. And yet, if I brought in a JV partner and I got normal bank financing, so he put in like 80 plus renovations, probably 150-ish on renovations, I would have to split that 50-50. So maybe my profit goes up a little bit, like maybe another 10,000, so I make 110, but I split 55,000. So I give him 55,000. He makes a great return, 6 months, 25%. I make 55,000, we're all happy, yet I actually make a better return by using private money. I mean, there's deals out there right now that you can get. You can go get 80% from the bank or 75% from the bank. You can go ahead and get a second mortgage on there up to 85, 90%. And then you can get, on top of that, you can get a promissory note. So you can truly buy this, you can buy it, and you get 110, 120% of the money. They're going to give you all the money to buy. They're going to give you all the money for renovations. I mean, if you have a good enough business proposal and the deal is that good, then definitely go ahead and take advantage of that. I mean, that's one of the aspects, right? Is you can go get private money. You can go work with a mortgage broker who specializes in doing this exact deal, and they're going to go ahead and put that together. And typically what I would do that on is a BRRRR. So we're going to link the BRRRR one down below. So buy, renovate, rent, refinance. And you can refinance and pull out that money so you can pay back the higher interest, right? Or, you go ahead and get your, a B lender on there at the very least, where you're only paying now 4.5%, 5%. So that's one of the deals. So you go to that specialized mortgage broker and they package that deal. I mean, on larger things, I'm buying a property right now. I put it in the description below. It's the 30 unit. It's not a zero money down deal yet. I'm getting a first mortgage for $2.5 million at around 5.5% interest only. I have a second mortgage being put on there for $1.5 million, and you remember my purchase price is $4.1 million. So at the end of the day, I'm in for $100,000. It's very little money down. Obviously, I'm going to need a lot of money to renovate that property. We're going to do a walkthrough of that building next week, so you can see, because I do close on that in 3 weeks, and we are going to move quickly on that. Well, it's not a zero money down deal, but for a $4 million property, I pay $100,000 plus closing costs. And it's not bad, guys. I mean, a lot of people out there will take it. So you can do stuff like that. So a vendor take back, you can have the vendor hold the mortgage, right? A lot of people do this, and I think this is some of the easiest ways to go about it. They go find their rich Uncle Gary, who owns a very nice house, has a good job, has a lot of home equity, and rich Uncle Gary goes ahead and gets a home equity line of credit. I think interest rates on those are 3 to 3.5% right now. You offer Uncle Gary, hey, I'm going to double what you pay in interest. So I'm going to give you 7%. And you take Uncle Gary's money and you go buy, I would typically say, again, you want to buy stuff that you can refinance out of and give Uncle Gary his money back. And I mean, the banks are obviously loaning out, it's free money right now. I mean, you can 5 years at 1.99, commercial stuff, 3 years, we're looking like low threes. I know in the States, like, you're getting a 30-year mortgage for 2.99%. Like, guys, this is free, absolutely free. A lot of these strategies for zero money down is I would do these on value-added properties. I wouldn't do it on properties personally that were turnkey, that I would be too high in debt. And I'll walk through the numbers on that 30 unit. I mean, I did. I'll link it down below of how I'm going to add value to that property. And so, I mean, initially when I buy it, I'm going to be very, like, my loan to value is going to be very high. I renovate 20% of the units, my value goes up, 10%, let's say 20%, 25%. So right there, my loan to value comes down substantially. I renovate half those units and my loan to value is now in that 65 to 70% range. This is where you need to be smart. You can't just go out and buy everything zero money down. You need to be building equity, obviously, in these properties, and you're using value add to do that. So take rich Uncle Gary's money. This is the same as going ahead and getting from the lender. Rich Uncle Gary's money is probably going to be cheaper because they know you, like you, trust you, and you're going to pledge some personal assets behind it as well, probably. You're going to say, rich Uncle Gary, I'm not going to let this sink. If I have to, refinance this house, do this, whatever. The next one would be joint ventures, guys. And I've talked about it before on this channel. Yet, if somebody comes to you and you don't own any properties and you're pitching a joint venture to them, and you've not done any other deal where you've gone in private financing and run the deal and done it all, you've never bought it yourself, why the heck wouldn't you take 10% of the deal, 20% of the deal, 25% of the deal to get started to build your track record. I mean, you can go ahead and take all the education you want, and yet if you go ahead and you don't do anything, you're never going to build that track record. You're never going to have a story to tell. Mandy Branham, obviously, the JV queen, her story is phenomenal. And yet, at the beginning, she didn't have a story to tell, so she had to go talk to a heck of a lot more people. And now, because she has such a great story, people have come to her. People literally come to Mandy and say, here's money, let's do something. And sometimes she's like, I've heard her say, like, this is too much, I can't handle it. Let me refer you to some people who can help you. And I think that was a mindset thing for Mandy too, right? And I said at the beginning, this is all mindset. So joint ventures are a way of doing zero money down deals. In my mind, these are the safest because you're splitting risk, right? So you're putting 25% down on the property, they're putting in the rental costs, and you're obviously going to refinance that money out. If you don't get all the money out, as not like a private lender, then you can tell yourself, I mean, Mr. Joint Venture Partner, we got 80% of the funds out, we still have 20. We know we're going to do a 2 or 3 year mortgage, at which time we'll get the rest of the funds out through mortgage pay down and appreciation of the property. I know a lot of people don't think of that as a zero money down deal, yet for the real estate expert, it's a zero money down deal. So if you look at my 30 unit, I have a joint venture partner on there, I have a VTB and a first mortgage. So for me, it's truly a zero money down deal. My partner, it's a low money down deal for him. It's not a no money down deal. And a lot of people might say, well, Mark, if you were able to structure it like that, why would you even bring in a partner? Well, it's one of the beauties of building a portfolio, and the way I do it, I always take everything to my partners because they've been there on every deal. So if I took them out on a deal where we needed very little money that we're going to get a high return on, well, maybe they're not there the next time. So I take every deal to them first. If I don't get anybody, maybe I'll probably just do the deal myself if I can structure it right. This is how I buy zero money down real estate. So I don't use any of my own money, whether it's flipping, whether it's doing duplex conversions, triplex conversions. If you're in the States, single family homes, you're buying at a discount, fixing up a little bit, getting the after repair value up, renting these things out, and holding these for the long term. Again, the only way to lose money in real estate is to hold for the short term. People are always going to need a place to live. I look outside of Ontario right now for real estate, yet in Ontario specifically, other than the downtown condo market, because it's flooded short term right now, long term we've never had a rent decrease since rent controls have been in place. So if you're in a rent controlled area, typically you're not seeing year over year rental declines because, again, it's an unintended consequence, but rental caps on rent, the unintended consequence is people don't build rental units. And therefore, when people move in, they need someplace to live. Nobody's building rental units. I have rental units. Supply and demand dictates that prices go up. All right, guys. So that's it for today. And again, guys, thank you for subscribing. Thank you for commenting down below. And thank you guys for smashing that like button. We'll see you guys in the next one.